Welcome, everyone. I'm Angelo Robles, and welcome to my Family Office TV interview platform. I'm also the founder and CEO at SFO Continuity, a private membership organization for families. And of course, many of you, because I've been talking about it quite a bit, also know my Family Office Masterclass. I really enjoy doing these interviews and being at the heart of the global single family office community. We are really getting right to it today. Trends in single family office legal structures. 99% US families are at minimal setting up structures here in the US. I do agree we need to cover this subject internationally, a minimum of Switzerland. And ironically, on Thursday, with a Swiss attorney, I am covering that subject. So my international audience, we got you covered. But some of the principles of understanding how to structure are relatively similar around the world, as we'll get to today. So there still is value for those from an international perspective. Our special guest today, and let's welcome Richard LeVine, who is special counsel in the private client and tax team at Withers. Many of you know Withers is an international firm focused on the incredibly successful, the affluent, and family offices. I've known them and some of their key people for many a decade, not wanting to give away my age. And I've known Richard for a long time. We're very fortunate to have him on when I think of families of incredible success, especially with complex tax issues. Richard is probably one of the first names that comes to mind. So, Richard, on that note, welcome to our show today.
Good afternoon, Angelo. It's great to be here.
And in terms of giving a little bit of context and then segueing right into the topic, I think that most family and family offices perceive the legal structure as kind of just what it is, part of the family office package. Families do not spend a lot of time looking to understand it. They think a basic structure, well, just like everyone else. Now, we'll get into late 2017 came along and a certain ruling happened that changed some of the dynamic to make it a little bit more valuable or optimal in terms of how to structure for certain privacy and primarily tax benefits. So families often step back and say, let us do an audit of our legal structure, or they should be doing that, to make sure that they're hitting on all cylinders. And I'm here to tell you, no offense to 99% of you, you are not hitting on all cylinders. Or if I'm using a Tesla, maybe that cylinders won't be applicable. But you get the big picture. The number one concern of the SFO in such an audit is going to be the substantiation of proving a business purpose, which is stepping back in my mind and wondering, why do you have a family office and what is the purpose of it to begin with? So on that lofty introduction and a little bit of identifying a business purpose, Richard, why don't I have you give a foundational overview and then I'll jump in with a lot of questions.
So family offices are a useful concept for successful families who find that they have a lot of details of their lives that they'd like to have in a more organized and focused and controlled manner. So what happens is that families are successful and they acquire lots of relationships, often in a very haphazard, disorganized manner. They have a number of financial accounts, they have investments in all kinds of private investments. Along the way, they've met people who talked them into making an investment, or they had a business partner who went into another direction. And so they have a very complicated financial life because they're busy running their business, and they often, lose track of all of the connections they have. And so at some point, there comes a time when they realize we have to get organized and we have to keep track of all of our investments. And we want to maybe take some more control and choose some of the investments ourselves or hire people on a full-time basis to assist us in decision making. We also have concierge functions. As families become successful, they have multiple residences and multiple vehicles of all different kinds, that drive on the land and float on the water and travel, fly through the air. And so you suddenly have a lot of activities to keep track of. You have philanthropic activities to keep track of. You have bill paying activities. So, there comes a time where you say we actually need to hire people and in doing so, we put these people and these relationships into a structure that is commonly referred to as a family office.
And henceforth, there is a perception, well, I don't know, it's a business expense, isn't it? Can I just deduct everything, including my investment expenditures? And I think there's been a history of families looking to squeeze that in, and maybe some of them, slip under the radar. The IRS is busy. But if you look at cases like Higgins, and I know that goes back many decades ago, and others, broadly speaking, families have not done so well when the IRS really focuses their attention on them for families that maybe, I don't know if I'd say push the boundaries on what's deductible in their quote unquote family office, or maybe that's the problem. Not a formal family office, just their pure quote unquote investment expenses. But that changed a little bit with the lender family versus IRS coming to a conclusion specific to that one family. I do understand that late in 2017. And I know that you've been following the principles of doing what was kind of discussed in that probably for decades, but it became more to the forefront during that time. If you could talk a little bit about, and again, this is going to be a pretty nerdy, deep intellectual conversation about family office structures. I would look at it as the assets are over here in one legal structure, multiple structures or entities, and the SFO management company is over here, perhaps a different domicile and a different structure. Now, we could get into how those intertwine, and should that be a C Corp and why? What's going to be the tax leverage and arbitrage? Or is that better as an S Corp or an LLC? Let's get into it.
Okay, so let's talk about the tax side of a family office. So generally speaking, the family is incurring expenses for people to help them with their investing, and they'd like to deduct those expenses. The problem is that prior to the 2017 Tax Act, you had a very clear distinction between expenses that are involved in a trade or business that are deductible under Section 162 in full, and prior to 2017, investment expenses, if you were not engaged in a trade or business, were deductible under Section 212 to the extent that they exceeded 2% of your adjusted gross income. Then in the 2017 Tax Act, they changed the deductibility of a lot of expenses. I'm sure many of your viewers will be familiar with the fact that state and local tax deductions were curtailed in the 2017 Tax Act, and so were miscellaneous itemized expenses incurred for the production of income outside of a trade or business. So after the 2017 Tax Act made investment expenses totally non-deductible, there is an enormous incentive to call the expenses your family office incurs trade or business expenses. So now you have to say that your family office is engaged in a trade or business. And the problem with saying that your family office is engaged in a trade or business is that historically, when you're talking about expenses incurred in managing a stock and bond portfolio, traditionally, there were three categories. There was a dealer who sold securities to customers, and so that would be your typical brokerage house. And family offices are not brokerage houses, and they don't have customers. They're trading their own portfolios. And then there are traders who trade in a very high frequency of trading. And traders are engaged in trade or business and can deduct their expenses. The problem is that many family offices, while they have very large portfolios, don't do frequent trading. They do occasional trading. And so it was historically difficult to get into the trader box, and most families would find themselves in the investor box. And in the investor box, you're not engaged in trade or business, you're just investing. And that puts you into the Section 212 non-deductible category. So the good news is that also, sort of serendipitously, at around the same time in 2017, the tax court handed down a decision in the lender case. And the lender is a family, a multi-generational family who started in the frozen bagel business. And they hit it big and they sold their company for $90 million. And subsequent to that, they were investing their money. And so the Supreme Court had basically said, investing your own money, no matter how much volume of trading you do, is not a trade or business. But the lender said, well, we're not really investing our own money because we created a family office. Our family office is a separate legal entity. And that legal entity is engaged in a trade or business and can deduct its expenses. So, Angela, would you like me to go through also the concept of allocations and setting up a family fund, and why setting up a family fund and making allocations becomes so important in this context?
Yes, and I'm assuming this all relates to Bonus 162 or IRC 162 and being technically a for-profit business. And why don't we start with what you said there, and then we'll segue into C Corp, S Corp, LLC. Should non-family members be active in quote unquote that entity? Again, this is a bit of a nerdy, deep subject, but we have to do it right. So please continue.
Okay. So historically, for quite a period of time, investment partnerships, not necessarily families, but investment partnerships where professional investment managers were raising money from third-party investors and managing that. They used a fairly typical structure of having a partnership hold all the assets, and the investors invest as limited partners, and then the professional manager is the general partner. And that provided a big tax benefit to the professional managers in that they could get an allocation of capital gain. If the underlying portfolio in their investment partnership produced long-term capital gain, they could be taxed on long-term capital gain instead of having fee income. It also meant that instead of being taxed in the state where their office was located, and often those offices were located in New York City, they could be taxed on their allocation out of the investment partnership where they lived, and maybe they lived in Connecticut and maybe the tax rate in Connecticut was lower. So there had been, for quite a period of time, this concept of having investment partnerships and allocating income to the people who were running the money. And families have adopted that structure because the benefit to the family is, if the family portfolio produces, $10 million of income, and they want to send $1 million to the family office, if the family office has a fee, is paid a fee, then we have the question of, well, what kind of fee is it? And is it deductible? And is it 162 or 212? But if you just say, we're going to give the family office 10 or 20% of the profits that are generated by the family investment partnership, then the various family trusts and individuals who are limited partners in that partnership, they're not paying a fee that they have to try to deduct. They just have less income. And the family office has an allocation of whatever income is generated by the investment partnership. And you don't have to worry about deducting. There's no deducting. There's just, instead of the family having 10 million of income and paying $1 million of fees, the family has $9 million of income, and the family office has $1 million of income. So the good news is we've completely eliminated the trade or business issue at the level of the family portfolio, where the family portfolio really is trading its own money and would have a very difficult time getting into the trade or business bucket, but it doesn't matter because they're not paying fees. They're just allocating among the income. Now you face the question of, we just allocated a bunch of income to the family office, and the family office has a lot of expenses. They pay rent, they pay salaries, they pay, for their Bloomberg terminal. So they need to deduct expenses. They can't enter into one of these partnership deals with all the third-party service providers they're in. So now we have to create a trade or business at the family office level. And that's where the lender case comes in. So the lender case said that their family office, their management company, was engaged in a trade or business. And they tried to compare the activities of the lender family office with the activities of the professional investment managers who had traditionally used this partnership structure and this allocation structure to try to decide whether the lender's management company looked like a third-party independent investment manager that was engaged in a trade or business.
Excellent in terms of an overview as we begin to dive in deeper. Now, as I remember, and Richard and I are both primarily Connecticut-based. I'm a little bit to Wyoming, the great state of Wyoming, but there's the tie-in, of course. I've known the Lender family, mainly Keith Lender, for many a year, and wonderful, and also provided interesting insight to this whole backstory. So just a little bit of irony there. But as I remember, even things like creating the investment policy statement, setting asset allocation, managing the managers, even if you're not necessarily the hardcore internal direct investor, or you are outsourcing more to managers, there still are investment services, including the 2 or 3 things that I mentioned, let alone more, aggregation, reporting to the family, etc., that are real expenses, correct?
Absolutely. And so we are definitely looking at the nature and amount of the activities that the family office is undertaking. Now, if you look at the lender case and you try to say, well, what were the helpful facts in the lender case that led to a favorable conclusion? There are several of them. One is that they had a highly educated person a member of the family who devoted a large portion of his time to managing the investment side of the family office, and the court thought that he had sufficient education and experience and background to be credible as a professional investment advisor, albeit not licensed. And we'll get back to that later about how licensing impacts this. And they had multiple unrelated family members who lived far apart, some of whom were personally adverse to each other and didn't get along. That they had multiple buckets. So one of the big helpful thing was they didn't just have one big investment portfolio and everybody shared proportionately. They had 3 portfolios. They had a hedge fund portfolio, a private equity portfolio, and a public securities portfolio. And different members of the family invested in different proportions. And that's a very important fact when we compare it later to the Hellman case. And
yes.
So Keith Lender, who was running the Lender family office, would spend time every year talking to the various members of the family, finding out what their cash flow needs and investment objectives were. And then each member of the family would allocate among the 3 underlying portfolios, depending upon their differing objectives and needs. So Keith was busy helping people craft a personalized portfolio. And that, to me, in reading the cases, is very important, that people were not investing pro rata and people were getting personalized advice so that it looks like the family office is providing a service to investors and not just hiring money managers to run the portfolio on a proportionate basis.
And now we're getting into a little bit of the art part to meet the quote unquote the hard science. And I kind of hinted at it before with effectively investment policy statements, often not one, because there could be multiple ages, branches of the family that effectively have different investment needs. So creating, you could argue, more complexity, but in some ways that might be good in terms of investment policy statements, asset allocation. You mentioned that person being Keith, having the 3 buckets, various allocations for each, depending on a variety of factors, different family members making their choice. Now, some people will look at that and say, that sounds more complicated. And you're right, it is. But the benefits of that, doing it right, So you have less friction in the family, less potential for intra-family litigation, which often brings a lot of families down,
Yeah.
coupled with what could be millions of dollars, in tax benefits. Yes, it often makes that extra work worthwhile. Now, there were certain advantages given the lender family was a good sized family with dozens and dozens and dozens of family members. What happens with a family that's a little newer to their wealth that may only have, including children, 3, 4, 5, 6, 7 family members? Does that make that model more hard to implement?
Absolutely. So let's talk about the Hellman case. Now, the Hellman case was another family office case that never reached a decision. The litigation started, there were some motions, and then the parties settled. But when you look at the orders of the judge in the final chapter before they settled, it gives you a hint as to the issues that were in play and why the Hellman family may have settled out of caution that they were going to be unsuccessful if they had pressed the litigation. So in the Hellman case, it was a younger family, and they had multiple family members, but they all invested proportionately, and they all owned the management company proportionally. So you had instead of having a management company owned primarily by one family member or trust for one branch of the family in the lender case, in the Hellman case, you had 4 family members who each owned 25% in the management company, and the management company invested, as far as I can tell, in one vehicle that all the members of the family invested in proportionately. So the fear in the advisory community is that the Hellmans would have lost if they had gone to judgment, because they don't look like they're engaged in trade or business at the family office / management company level, because they don't have multiple customers, multiple service recipients who are each getting a bespoke investment portfolio. They have one customer who's getting one investment portfolio. And so it just looks more like the family is investing its own money rather than having a management company that is managing portfolios for multiple investors.
And this may relate then to what we could do, or mainly what you could do with families that don't have the exact perfect profile that the lender family may had. Now, I also happen to know, and we don't have to mention her name, I've known her for years, there was a non-family member, and that might be key here, a non-family member key executive that was a part of that family office team. Does it help? It's believed, given that the lender family is the one that won, that is specific to that case, that to get the maximum advantages as we're describing, it would help to have a non-family member identified as a key executive be involved in the family office. And exactly how are they involved, from profits interest to a share of the LLC, the management company? Again, I know we're getting into the art part that gets complicated more so than the science part of the equation.
Well, it certainly helps. Again, if things are done on an allocation basis, you're probably not going to want to have your key executive employee be in control, because we're going to talk about the securities law side. And on the securities law side, it's important that the family retain control.
Yes.
But it's, again, if you do have private equity, if you do have real estate, things that generate long-term capital gain in the family's portfolio, then there is the same tax advantage to employees as there is in the private equity context, where the managers want to get an allocation so they can get long-term capital gain instead of fees that are taxed as ordinary income. Your key investment employee would be very happy to be able to get a allocation, a profits interest in your management company, so that if there's an allocation of long-term capital gain from the family portfolio to the management company, you can allocate some of that long-term capital gain to your key employees. So they'll be very happy to take that. Now, what you don't want to do to them is cause them to have phantom income. You don't want to hand them a piece of paper that says someday you may get some money and have them have to pay tax when they get the piece of paper. So when we call it a profits interest, we're doing that for a very specific reason, because the IRS has conceded in Revenue Procedure 93-27 that the receipts of a profits interest, an interest that only shares in future growth and doesn't get any share of the existing value of the entity, can be received free of tax, and it can be received free of tax even if it vests over time. So the fact that it is property received clearly in connection with the performance of services does not necessarily trigger tax on the day it's received or the day it's vests, which is the normal rule for receiving property for performing services, is that it is taxable either on immediate receipt if it's saleable, assignable, or upon vesting if it's subject to performance restrictions. But in this case, because it's deemed to have a value of zero, because it only shares in future profits and future profits are speculative, for administrative convenience, the IRS basically says you can treat the value of that property when received as zero. So we do tend to give key employees a profits interest, and then they don't have any tax on day one. They don't have to make a financial investment on day one, so they don't have any downside risk of loss when you hand them the piece of paper. And if the underlying portfolio generates long-term capital gain, they can be taxed at long-term capital gains rate. So it is a very useful tool in attracting talent to be able to offer someone who might otherwise just be paid a cash salary and cash bonuses and pay ordinary income tax. And if they're in New York or California, that tax rate is north of 50%. To allow them to get long-term capital gain as their compensation is highly attractive in terms of getting talent to come to your family office.
Lots of questions from there. Why don't we start with is explain maybe a little bit to the audience, again, non-family member, quote unquote, key executive, likely given the lender case, it helps, profits interest. Is profits interest the same as having an equity stake, an ownership stake, a unit membership interest in the management?
Generally speaking, yes. So it might be a non-voting interest, but generally speaking, a profits interest means this entity is taxed as a partnership, and the person who received the interest is a partner. So that may or may not give them certain access to information under state law, since they own an ownership interest in the entity. And so you can't hide the ball from someone who you give a profits interest. So there are, non-tax considerations in making this available. They may or may not be treated the same way for benefit plans. The IRS view is you can't be both an employee and a partner. So if you have a key employee who you make a partner, they won't be able to participate in the company cafeteria plan if your family office sponsors one. So depending upon scale, that may or may not be an issue. But there are non-tax considerations in giving an equity interest in your management company vehicle to a key employee.
Okay, so the equity interest, whether stock in the corporation or whatever member units in an LLC, all things we'll get to shortly. This could concern me. This could make me feel, I'm making up the number, 19% of my management company, that is my SFO, is kind of not in, I wouldn't say family control, because like you said, it could be non-voting shares, but not everyone stays at an employer forever, Richard. I know that's hard to believe. Is there a mechanism in place where if that person gets fired or moves on at their own accord, that their interest could be valued and purchased out?
Absolutely. You can certainly, as with all other, sort of incentive compensation to service providers, you can put conditions on such that if you want to sell the management company, tag along and drag along that they have to sell when you want to sell. You can have buyback provisions that are part of the person's employment contract that says when they terminate employment, you can buy the interest back. And depending upon whether they're fired for cause or not for cause, maybe you can buy them back, at a discount to what it's really worth. So there's a lot of ways of skinning the cat here so that the family retains effective control while getting the tax advantages, not just for the employee, but for the family of having the family office engaged in trade or business.
And what happens, and you actually hinted at it earlier, describing kind of the concept of why to have a family office. Right now, we're being very investing centric, yet my audience also knows that I talk about investing is just one part of a generational family's generational success, family continuity, a very important part. And most family offices are going to have investing and everything around investing be a part of most family offices. But how about family offices that are more concierge focused on fulfilling services for the family, on internal security, on art purchases, on how about things even that are more estate centric with an in-house attorney or tax centric? How could the family have that under the auspice of a SFO, aka management company, yet still get the tax benefits of what they're paying that employee? Or is that far easier because it's not as limited by what could have been Section 212 on the investing side? And I didn't ask that question in the best way, but I think you got the big picture of it.
Yeah, no, I think that's a very good point, a very good question. So the nice thing, as I said earlier, about allocating the income away from the family, and so you move the deduction question to the family office and whether the family office is engaged in trade or business. And I think if the family office is clearly providing non-investing services, that certainly adds to the activity being conducted by the family office and makes the family office look more like a trade or business. And so the good news is the fact that you get paid as an allocation rather than a fee doesn't prevent you from providing services for compensation, and providing services for compensation makes you look like you're being engaged in a trade or business. So I think the concierge services, the non-investment kind of services, are helpful as to the issue of whether the family office entity itself can deduct its expenses, whether or not those expenses relate to investing. So I think here, the broader the menu of services that are provided by the family office, the stronger your argument is going to be on the tax side that the expenses are deductible.
100%. Okay, let's get into now, and we're sticking to the AKA the management company, the family office. S Corp, C Corp, LLC, why? Which one?
Okay, well, that's a great question. And as you said, this is more art than science. There is not one form of entity that is always the best for every family. So some of the competing considerations are that the tax rate at the entity level currently for corporations is 21%. The tax rate, if you run something on a transparent basis going up to humans or trusts for the benefit of humans, is going to be 37%. So if you are concerned that your family office may run profitably in some years, and that is certainly a possibility, and families have to be comfortable with the idea that some years the family office may actually make a profit, because otherwise, if you know you're never going to make a profit, if you are targeting how much gets allocated out of the family portfolio so precisely to match your expenses, the IRS may say, it's not really an allocation. It's really a fee for services. And all that benefit of saying we don't have to worry about trade or business to the family, we only have to worry about trade or business to the family office, goes away. And they say, not an allocation, now it's a fee. And now those individuals and the trusts are back into the 212 box. So you want to run allocations out of the family investment portfolio or portfolios that fluctuate from year to year. And some years the family office is short and has to borrow money from somebody to cover its expenses. And some years the family office is profitable, and so the tax rate applicable to the family office matters. And so you have to worry about form of entity. Another thing that argues in favor of corporate solution is the lore, not the law, but the lore in the tax law is that it's easier to write off expenses at the corporate level than it is for individuals. So people, your accountant would rather you take expenses either in a C Corp or an S Corp rather than putting them on your own Schedule C on your own personal 1040. So some accountants will argue in favor of corporate solution. The problem with corporate solution is there's a second level of tax to get the money out of the corporation to its shareholders. And if you're putting appreciated assets in, if there's intellectual property, if there's goodwill, if there is, family name that's being used that might appreciate in value, if it's stuck in a corporation, you can't get it back out without paying a corporate level tax. So a lot of people will want to run as a flow through. Again, we're trying to compensate talent to come work for your family office. There's usually not as many layers and levels of promotion available. So being able to compensate people with a profits interest so they can get long-term capital gain on a portion of their compensation is a big benefit that's not available if you use either a C Corp or an S Corp. If you use a C Corp or an S Corp, either people are going to pay tax up front, or they're going to have to make an investment, or they're going to have risk of loss, or they're going to have ordinary income on everything they get at the back end. So there's always going to be something about the compensation of employees that is suboptimal if you use a C Corp or an S Corp as compared to using an LLC taxed as a partnership. So, there you can do it. You have more flexibility if you're going to have allocations that are not just straight proportionate. If you're going to want to say you get 5% of this and then 10% above this IRR and 20% above that IRR, if you have some key investment employees, you want to say, if you do a really good job, we're going to share a big percentage of the profits with you. Much easier to do as an LLC taxed as a partnership than to try to do that in a corporation. So again, because there are competing considerations, because they cut both ways, each family has to take a look at their situation and their goals and objectives and decide for themselves which kind of entity is best for them.
Oh boy, this is so much art, more so than we would all like it to be on more of the legal and tax side. So my next question could be opening up a can of worms that is a different conversation. Either or, whether it's stock in a corporation or whatever unit or memberships in an LLC, on the, let's call it the family side, is there any logic as to who has control of that? Is it individual family members, or are you better off having varying revocable or irrevocable or dynastic trust? And now I know we're opening up estate planning issues, which we probably don't want to make it, again, a 10 out of 10 hardcore tax discussion. I probably should have left that question out, but it's already thrown out there. Richard, the audience expects at least a 1 minute gloss over answer.
We've seen it done pretty much every way under the sun. So depending upon whether the family is or is not comfortable on the family office, having value over time, who is supposed to benefit from that, how, which family members are really participating, which family members are generating that value at the family office. As we said, in the lender family, there was one family member who took the leading oar. And so, that branch of the family expected that if the family office was ever worth anything, it ought to be theirs. And it was reorganized over time to sort of reflect that. So, whether or not it makes sense to have individuals' own interests, whether it makes sense to have, irrevocable purpose or dynastic trusts own the family office, whether it makes sense to allow key employees to participate will again depend in part on the goals and objectives of the family, the personalities of the family member. A lot of times it's hard to get clients to do what's in their long-term best interest. These are people, you don't get rich by letting other people make decisions for you. So these are people who quite understandably want to remain in control and want to understand how control is exercised. And so sometimes you may pick a form of ownership for the family office, which is really optimized to the comfort level of the senior generation of the family, rather than to purely legal optimization in the long-term, family benefit. And that's fine. That's part of the art here, and part of the service that, that professionals are providing to the family, is to balance and juggle all the competing considerations.
And the other consideration we didn't discuss effectively is domicile. So if you're setting up a structure, let's call it a C Corp, an LLC, it really doesn't matter. Where you set it up could matter from a couple of perspectives, one being privacy, the other being taxation. So we're all familiar with Delaware, New Hampshire, Wyoming, South Dakota, Nevada, Alaska, as generally being perceived as being very private, kind of protective, and quote unquote, I believe every state I mentioned has no state tax. Does domicile matter in the SFO management company domicile or et cetera.
It absolutely does. So there's a number of competing considerations. As you state, there's state level tax, and obviously you're going to want to set up in a state that doesn't impose its own state income tax. But there's also regulatory burden. So, for example, Wyoming offers unregulated private trust companies that are, very cost effective, whereas, South Dakota, if you're looking for regulated status, and some families are looking for regulated status, South Dakota's regulation is probably the lightest touch of the regulated places. So, we may choose where to domicile based on whether the family is or isn't looking for regulatory scrutiny, whether they, are just looking to minimize the expense of managing the structure. And speaking of expense, there is another issue besides taxes that we haven't talked about that I think we should put on the table, because it's another one of these regulatory issues, and that is securities law. So the securities law impact on family offices is its own little, area of legal practice, right? So generally speaking, under the Securities Act of 1940, investment advisors have to register with the SEC if they want to run someone else's money. So the question is, why doesn't the family office have to register if it's going to manage the family's money? And the answer is that in 2010, the Dodd-Frank Act said statutorily you can have a family office exception. They were tightening up regulation after the financial crisis of 2008-9. They said, here's how we're going to tighten up regulation of the securities industry because we don't want to have another crash. But they said, but we understand family offices that don't have to be subject to all this very burdensome regulation. And it is very burdensome. There's all sorts of restrictions on record keeping and where your computer server has to be. And there has to be a separate card key to get into the computer server room. And all of your emails have to be saved for 7 years on storage offsite. It really is very burdensome in terms of cost and expense to the family. It's not just filing a form with the SEC and calling it a day. So families very much want to avoid having to register as investment advisors, having their office register. And the family office exception drives a lot of these decisions of who the family office can run money for, who can own the family office, etc. So basically, the family office exception says can only run money for family entities, which is basically entities whose members are family members or key employees of the family office, and former family members and former key employees in certain circumstances. And that the family office has to be controlled by members of the family, not key employees. So you can run money for entities that have key employees in them. And you can have the family office owned in part by key employees, but control has to be in the family. And then you have to not hold yourself out as running money for third parties. And most family offices are smart enough not to do that. So if you make sure that you're only running money for family and key employees, and that you are controlled by the family and you don't hold yourself out, then you qualify for the family office exception to securities investment advisor registration, and your family office doesn't have to register. So it does make it, you can't do this for multifamily office. You can't have a multifamily office and be exempt from investment advisory registration. So we are really talking about single family offices here, and making sure that you qualify for the family office exception is typically going to be high on the goals and objectives of a single family office so that they can avoid registration. So that will again drive who owns the family office company and who controls the family office company, so that you make sure you're on the good side of the line, which is that for tax purposes, you are engaged in a trade or business, so you are performing services for others. But on the securities regulation side, you're not running money for others. You're just running your own money, so you qualify as a family office. And so, this is, again, where the art is in arbitraging between the two systems, making sure you get the tax result you want and the securities law result you want. And that's why, it's just not one shoe fits every foot here.
No, it's not. And actually, I was getting to the SEC exemption during Dodd-Frank, like you said, in 2011. And just adding to that a little bit, trust me, they wanted single family offices to register. If it wasn't for the effort, and I was moderately early in my SFO career, I probably could have been a little bit more vocal. So I'm not saying I was a big aspect of it, but there was a specific trade group of legal professionals in the community and single family offices. I tip my hat. I don't have my cowboy hat where I can just reach it. But to them, even though it may be well over a decade too late, if it wasn't for their efforts, and kudos to them, it would have been a lot worse if you consider, which I guess I do, registration. Now, you hinted at private trust companies, and a regulated private trust company would have been one example that they could have went in that direction. And we're going to get a little bit more, not too much more, but a little bit more into private trust companies in a second. But before I do that, and before we continue, I would like to just take a moment and remind people this is a very deep technical discussion that is not all science. There is some art and nuances here. This is specifically our opinion, whether it's mine or whether it's Richard's. By the way, something may come down or our interpretation may change tomorrow and our opinions change. Just like playing poker, just as new information comes in, or our perception or our knowledge of how we critical think during that information, it may change. So you may hear this interview a week from now, a month from now, I don't know, maybe 3 years from now. And the nuances of it and our opinions of it could be totally different. So at the end of the day, utilize it for entertainment perspectives. At the end of the day, do your own research, make your own decisions. That's on you. That responsibility is on you. And just a little bit of a heads up. You all know that already, but a reminder from me.
What do they say? That this does not reflect the views of Withers Bergman LLP. And if you haven't signed an engagement letter and paid us a fee, this does not apply to you personally.
Exactly. Boy, we're really checking the box in our disclaimers. And that's because in today's world, these videos kind of live forever. And again, conditions change or simply interpretations. This may have a different perspective of it because there is a lot of art in this that's involved here. So just clearly understand that. Do your own research and make your own quote unquote decisions. At the end of the day, the buck always stops with you. My other comment before we move on, and I know some of you have mentioned that I probably overdo this a little bit, and I probably do. So pardon me. But I don't think there's enough of these deeper level discussions going on in the community. It's too much built around investing only, which is very important, or simply hosting events that are often sponsored like there's no tomorrow with a lot of conflicted information. And yes, I was a part of that as well. I do understand that. I think I did a far better job than most, but we're all imperfect. But I do take pride in being competent, of being in this community that I love for decades, and the opportunity of having intellectual discussions, which is why that members of my SFO continuity, participants in my family office masterclass get something far deeper, far deeper than they're used to. What I would almost call a dream team of deep thinkers on topics like this, and certainly Richard would absolutely qualify for that, but having the collective wisdom of incredibly intellectual people that often reach hundreds to thousands of single family offices and getting truly competent intellect at your fingertips that is deep, I would like to hope practically completely conflict free. That's rare. So yes, if I'm touting my own horn or being my own sponsor of this event, then so be it. But again, these are some of the advantages as we move forward in our charter membership at SFO Continuity that my members do receive on a more deeper, personal, even deeper than our 1 hour plus conversation today. So if you haven't, take a look, and at angelorobles.com, you could kind of figure it all out. So Richard, in continuing our dialogue, I think relatively in a brief interview, we covered pretty deeply the management company, the SFO side, but there's the other picture, which we're not going to spend as much time on, but there needs to be assets to manage. And how are those structured? Again, I go back to, is that a series LLC? Is that a family limited partnership? And I guess there needs to be agreements between the SFO management company and the asset that holds, or AKA controls, if a trustee to the asset. Again, I know I'm going around in circles here. This is a complicated subject, folks. I mean, we can't get around that. But talk a little bit about that perspective.
So we do see series LLC used. Some families form separate entities, some do series LLC. I do think this was one of the most helpful facts in the lender case, that they had multiple entities with different investment goals and objectives, different asset classes in each of the different entities, and that different family members invested disproportionately in the various different portfolios. So I do think that the larger and more successful family offices do arrange themselves this way. They do create different portfolios, different asset classes. They do permit people to invest in disproportionate across the asset classes. They do, subject to liquidity constraints, give people periodically the chance to rebalance separately from how other family members rebalance. They let you take money out of the credit fund and put it in private equity, or, out of the hedge fund and put it into fixed income securities. Whatever you want to do, they allow. So yes, having vehicles to hold the portfolios that facilitate rebalancing among family members and disproportionate investing among family members, I do think that is an important part of creating the structure for your family office. And obviously, there are tax consequences that will flow from this, and not just in terms of how the underlying investment performance is taxed, but in terms of making an allocation. One thing that has caught on a little bit in the community is different allocations for different asset classes. So if you have a number of series in your LLC, you might say, out of the private equity fund, we're going to give you a 25% carry, and out of the public equities, we're only going to give you 10%, and out of the hedge fund, we're going to give you 15, or what have you. What's curious is the IRS has stated they view varying the allocations as evidence that it's not really an allocation. Richard LeVine does not view it that way. I think if there are caps on how much you can get, if there are floors and guarantees of how much you're going to get, caps and floors do make your deal look less like an allocation. But the fact that you say in a different asset class, I might get a different carry, I don't think that is indicative one way or the other of whether it is an allocation or a disguised fee. So I would not caution people to be too concerned about setting up different allocation percentages for different asset classes, but I would caution strongly against putting in caps and floors.
Yes, a very good point. And in terms of, again, separating the management company from the assets, I guess usually it may be more of some call it an investment holding fund. It may be an LLC, commonly a Delaware quote unquote series from the most commonly that I see. But I did mention the state Delaware. So again, I go back to the domicile question. I do think that for privacy and tax purposes, absolutely, domicile is important. Would you recommend that the SFO management company, being in one of the states that we described, be different than the state, and why, where the assets are primarily under the auspice of, say, a series LLC?
Absolutely. It all matters. Even in Delaware, the new, FinCEN CTA, the Corporate Transparency Act, what gets reported is different for corporations and for LLCs. I still haven't found out what was motivating them to create a different rule, but they did create a different rule as to what information gets reported. So it's very important to take very sophisticated advice about which jurisdiction and which form of entity in which jurisdiction, because there's more than tax at stake. There's how much reporting gets made on the Corporate Transparency Act. There's state law rights to access to information that vary both from state to state and among different kinds of entities within a state. So unfortunately, there's no simple rule of thumb. There's no one best entity or jurisdiction for everyone, but they definitely do matter on a number of axes. And it's important to make sure that you are addressing all of these considerations in picking your domicile. So for example, we have clients who are worried about creditors and they say, well, I have to form my trust in a creditor protection jurisdiction and they're all the same. But they really aren't, especially in terms of every state has exception creditors that have an easier time attacking a trust than somebody else. Not, every state has its own list of exception creditors. So, it's commonly considered, if the person you're really worried about suing you is your spouse, that maybe Nevada is best. But for other considerations, maybe South Dakota or Wyoming are better than Nevada for other classes of creditors. So again, you really have to get bespoke advice to your particular situation. And, an unmarried brain surgeon might have a different view of what risk they're most worried about than, someone who's married with 4 kids and, is devoted to raising their children and doesn't work outside the home. It's a different risk profile, and they may find that a different jurisdiction or a different form of entity is more suitable for them.
Of course. And I'm assuming a little bit more legally straightforward. And I did hint at it earlier. You have the SFO management company, you have the whatever it may be, the LLC or series that holds the investments. And again, this is art and science. It gets complicated. But the management company does need to have agreements verifying what their services are and what they're getting paid. But again, I'm assuming from my experience, those are pretty straightforward legal, crossing dotting the I's and crossing the T's.
And we often, some people want to have everything in one jurisdiction. Then they feel like, well, I'll go visit there and I'll meet with my local service providers and I can get that all done in one visit. Some people like jurisdictional diversity. They like knowing if anybody's going to complain about my structure, I want them to have to sue me in 5 different states before they
I
can
agree
get
with
their hands
that,
on
but I know that's more complicated.
I'm just saying that I don't disagree either. I've certainly put together structures that involve multiple jurisdictions where someone said, I just want to make sure that it's not easy for someone to get a freezing order over my stuff. And so I want my stuff in a bunch of different jurisdictions. But
let me make things a little more complicated than I need to. You're the one who brought it up, so it's your fault, Richard. On Thursday, I'm having a quasi-similar discussion with Martin Michaels at Baker McKenzie.
Oh, sure.
He's a U.S. born here, but in Switzerland. He's very prominent as an attorney. I've done some things with him in the past to families buying banks in Switzerland. So we'll save a deep part of that discussion for him. But to throw the monkey wrench in our more U.S.-centric conversation, could you make the argument for a U.S. family to structure their single-family office not for tax benefits, simply for additional, let's call it creditor and privacy protection in an offshore jurisdiction?
There certainly are benefits of going offshore. There are burdens. Generally speaking, you're going to have a higher reporting burden, and some of the penalties for failure to make the tax reporting on foreign structures can be quite punitive. So you want to make sure you have very good advice to make sure if you go offshore that you're dealing with your annual compliance. But assuming you're going to do all the compliance, if you are outside the United States, you're not subject to the jurisdiction. Your money is not subject to the jurisdiction of the U.S. courts. So you can go live with your money if that suits you at some point, which is an alternative that people who are purely domestic may not have, because the U.S. courts will be able to take jurisdiction over all of your family wealth. And I must tell you, in the current world environment that we're living through, the Chinese say, "May you live in entertaining times, and interesting times is meant as a curse, right? Boring times are safe, and the blessing is to live when everything is boring and goes according to plan. Obviously, now with the war in Ukraine, with what's going on in Gaza, we're not living in safe and secure and calm times. And I have people who are very worried about elections in the United States and the direction of our country's government, and they want geographic diversification outside the United States. They want to have underlying securities issued by non-U.S. companies held in custodians outside the United States, in legal structures outside the United States. And I'm not going to tell them you're crazy, you're nuts. I'm not going to do that for you. That's their judgment to make about the world situation. I'm happy and proud to be an American, but I can't tell them there isn't some benefit in going offshore and having geographic diversification, just like some of the immigration lawyers will say you should have, diversity of citizenship and have multiple passports because you never know. I agree that it's good if you're a wealthy person to have multiple passports. I tell all my wealthy clients, a U.S. passport means you're going to have to pay a lot of taxes and file a lot of forms, and you'll be the first person to get shot if your plane or boat gets hijacked, unless there's an Israeli on board.
Unfortunately, yeah, that's true. And my audience knows, and one of my master classes is sovereign risk and disaster preparedness. And I have done interviews with Riaz from your firm at Withers before as one of my resources for having, why don't we call it jurisdictional optionality?
Optionality is a great word.
What's the downside? Yes, it is going to take some money and time to, if you have the resources, to having multiple passports in the right, and I don't know if there is any one right, but for you, the right jurisdictions and a diversity of an onshore and an offshore plan with assets. Did I make your life more complicated? Absolutely. But again, do you want to have family continuity? Do you want to sleep at night? Do you agree that the world is going upside down and there's lots of problems both here and around the world? If you do, and that bothers you, and some people say that I rustle that up a little bit, fine. I'm just talking about there are certain things. There is no one perfect solution, but there are things you could do to have more optionality of your diversity, your assets, your jurisdiction within some level of reason. But we'll save deeper discussions on that for a different time. As we maybe head a little bit to the home stretch, the final 5 to 7 minutes, did you want to give a final commentary as well? Because I think we only touched on it lightly. And yes, I'll have Al King on from South Dakota Trust Company and others. But on private trust companies, you briefly mentioned unregulated, which could be very cheap to do, like thousands of dollars. You could do that in Wyoming. But maybe if you do fall under what could be not being or not qualifying for the exemption, there is going to be certain advantages and other advantages than that to doing a regulated, quote unquote, private trust company. Again, we're not looking to make it a 1 hour discussion about that, but in 1 or 2 minutes, talk about how that could intertwine into the family office management company and assets.
Look, I am a big fan of private trust companies. I had a client once who had 14 or 15 trusts. And I said, you should really think about having a private trust company. And he went to the large, money center bank who was the trustee of some of his trusts in Delaware. And they said, "Oh, that's crazy. You're not rich enough to have a private trust company. And this is ridiculous. And we can be the trustee of all your trusts. And you'll have one-stop shopping with us, what have you." And I went to them. I said, I don't like to take food out of anybody's mouth. And here's the deal. We're going to have a private trust company in Wyoming, and it's going to be service trustee of, the 15 trusts. And we're going to be able to form it for, $30,000, and it's going to cost $10,000 a year to operate. If your bank is willing to serve for anything like that kind of number, fabulous. You can take over as trustee of all these trusts. And of course, the banker, had a heart attack. And when she, rose from her unconsciousness, she said, "No, there is no way in the world that I can, run 15 trusts for anything like that. It's going to be 10 times as much if you use us." And I said, well, that's why I introduced the concept of a private trust company to my client, because it was going to be enormously less expensive than having, a big bank in Delaware serve as corporate trustee, and you get the benefits of a corporate trustee. So you get the estate planning benefits. You can keep the assets of the trust outside of your estate. You can benefit from the trusts, even the ones you set up, because Wyoming is a creditor protection state. And because it's a creditor protection state, the assets that you put into your trust, as long as it's a wholly discretionary trust with an independent trustee, remain outside of your estate. And so, it provides the legal framework you need to get the tax result you want. And so it can be a very powerful tool. Family members can take part in the administration. You have to have an independent person who serves as the independent distribution advisor or independent people on the committee, but you can be on the investment management committee, you can be on the administration committee, and as long as you have an outsider who can approve amendments to your governing documents and an outsider who can approve distributions, you can maintain a lot of privacy and a lot of control and get all the tax results you want. So I'm certainly in favor of private trust companies thematically. And as you say, Wyoming has a very good environment on the unregulated basis. And if you want to be regulated, maybe you're engaged, maybe part of your family is in a business where everybody who owns an interest has to be regulated, has to be licensed in some way. And maybe as a prerequisite to that, you need to have a trust company that is, regulated, in which case South Dakota has a very nice environment for that.
I completely agree. I've been a big advocate of PTCs, private trust companies, for years. I think they're broadly underutilized. I think practically no one appears to even know really on unregulated private trust companies how amazing even they could be, including, and you hinted at it, from a family governance perspective, even structuring insurance on directors and officers, and hard to get trustee assets on. There's certain assets that are very hard, could all kind of be swept into varying private trust companies, including some of the advantages, admittingly, maybe more so for the regulated type, but they should definitely be explored. I also think offshore, and maybe as we're beginning to conclude, there are certain strategies that we're not going to have the time to do a deep dive on. With two of your fellow colleagues, I think 2 years ago, I did a pretty deep dive, Ed Wren and one other, it might have been Canvas, I forgot, from Withers, on captive insurers. But for truly significant multi-billion-dollar families, weaving in onshore and offshore captive insurers, private banks in Switzerland, all this is why people, and I'm going to say this, not Richard, I think around the world, especially for that kind of clientele that I'm describing, I think there's like 50 attorneys that really, really know deeply, for a multi-billionaire family, a lot of the issues that we just spoke about now, and that I'm lightly weaving into with onshore and offshore, with understanding captive insurers, with the benefit of buying banks, and weaving in a variety of different strategies, not for the tax arbitrage of an American citizen, because that's basically not there, period, for the most part. But especially for someone who's non-US, there's lots of very complex things that they could do, but that add a layer of jurisdictional optionality, I could argue a strong layer of protection, and for them, maybe some significant tax arbitrage as well, that again, an American citizen or even a green card holder is going to be far more limiting on. But if you had a concluding comment relative to how that all weaves together, including banks and captive insurers and private trust companies and SFO management companies, this is, again, so much art, even more so than science. Just not a lot of people have the internal competency or the firm that has the resources to deal with a lot of these issues, Richard.
Well, Angelo, thanks for bringing that up. Look, we're not the only firm that does this, but it certainly is a core area of our expertise. We have deep experience and a deep bench, and we're always happy to help families review their existing structure and make sure that it makes sense. There are, legal changes, tax changes, regulatory changes, and you want to make sure that your structure keeps up and that it reflects where the family is today, financially, personally. As you say, passing along family values is not easy. And it takes a lot of thought, and the structure can, I think you pointed out this earlier, it can help the family run smoothly, and it can add to irritation and conflict. And we want to make sure that your structure is not adding to irritation and conflict.
Indeed. And we'll have you and some of the other wonderful attorneys at your firm and other firms too, but I don't think there's a lot of them. It's a pretty limited number to go deeper dive into both international, into banks, into captives and how that does weave into, and you don't necessarily have to be a multi-billion-dollar family. Some of that does trickle down to lesser, but we'll leave a little bit of that for the future. One final comment from you. Unfortunately, I still see this far too often, and I will give Tom Handler in Chicago credit for bringing this up a lot because he is correct. Far, far too many single-family offices are structured as embedded inside a still active private company. That is not proper. Not only are you commingling employees, you're subject to lawsuits, to not following certain ERISA guidelines. You're definitely not qualifying for what could be the tax benefits you could get if you do it right. Why is this for families that still have an active private company? Why is this almost always, shockingly, the default?
Well, let's face it. As I said, people don't become wealthy by leaving decisions to others, and they don't get wealthy by frivolously frittering away their money. So you have people with the skill sets embedded in your company, right? You have an accounting function, you have a bookkeeping function, you have administrative assistants. So what tends to happen is that people use the resources they have, and then as they grow, it becomes difficult both from a cost perspective and from a mental bandwidth perspective to say, you should stop using your personal administrative assistant and the company's accounting department to run all of your personal financial affairs. And you should set up a separate family office and hire separate people, and they should run the money that you've taken off the table out of your company. And that is absolutely good advice, and it is worth the time and energy, but you've got people who are tremendously burdened in terms of, that draws on their attention. And when you say, let's have a long meeting, and after the long meeting, we're going to spend a lot of time having more meetings to implement the idea I sell you on to have a family office, you start getting people who say, I'll worry about that after I sell my business and retire. And of course, the people who are successful at building big businesses, retire on their way to the emergency room when they're about to pass.
Yeah. Oh boy, Richard. Well, we covered a lot, but we did leave a fair amount on the table. Again, that's why this could also be its own quote unquote masterclass, which to me really is over multiple days of 18 plus hours of deep and diverse instruction. And these are all things that I personally love and do. So jump on in. But before I get to my close, Richard, why don't I give you the floor to conclude? And for those that would like to reach out and connect with you, how could they do so?
Certainly happy to talk family offices, single family offices with anyone who has one or anyone who thinks it might be helpful for their life situation. And you can reach me, at my office at Withers Bergman, richard.levine@withersworldwide.com. And my phone number is 203-789-1320 is the front desk, and 203-974-0317 is my personal number, and my cell is 203-376-8798.
Perfect. And again, I don't often do this, but I've known both the firm and Richard for a number of years. He really is one of, if you want to know who I would consider among the dream team, and I'm pretty big on that, definitely Richard would be one of them. So you kind of know one of my secrets now. I definitely recommend reaching out. Again, that's Richard LeVine, LeVine. You could also look him up on the Withers website. You could send me a note. I'm happy to make a connection. And I did check. He's even on LinkedIn. So I highly encourage you all to have an opportunity to reach out. He is one of the true treasures in the community. And although we kept our conversation 99% US-centric, both him and the firm are very much international as well. So I could have also covered that topic with Richard. So
we'll do that next time.
And we could certainly do that next time. In my conclusion, I know this was a bit of a deep dive into a little bit of a technical, although as we learned, a lot of art, probably more so than some of you expected. And this is my obligation, my dedication to the single family office community, that legal and structuring issues are very, very, very important. The vast majority of families are completely not optimized, even after lender and being more aware of the issues. They gave it a little bit of attention. They cleaned some things up a little bit 2018 into 19, and for the most part, kind of forgotten about it. Shame on you. Take responsibility as the family member, because the buck stops with you and the executive in the family office. These issues are very, very important. Being a part of what I'm building at Family Office Masterclass as a deep educational platform and my private membership community at SFO Continuity makes sure that you have optimized resources through me and my dedication and my knowledge, my competency in the community on deep intellectual issues, far deeper than me. People like Richard and others that I know in the Rolodex of people that I could bring in to be of value, both in terms of content, in terms of networking and direct connection. So don't be on the sidelines. Don't be inactive. Now is the time to step into it and have an opportunity to join what I'm building, which provides you with more than enough, if anything, an overwhelming amount of content and resources and connectivity to be great. If you're going to have a family office, it makes no sense to be mediocre. I hope you all agree on that. Like, try to be great. And by the way, the difference, as Jim Collins wrote about, to go from being good to great, and I know it doesn't sound that far apart, it is hard. So that whatever it may be, 5 or 7% better once you're already good. And these are all things that I focus on best practices, on OKRs, on things, objective and key results, and how to get to that next level. Again, I do enjoy the intellectual aspect. That's just me. Maybe with most of you, it's not. That's cool. Like, it's, whatever your choice. But if you're interested and want to strive for that greatness and have a level of the content and resources and connections, jump on it. You all know how to reach me, again, through AngeloRobles.com. I'm Angelo at AngeloRobles.com, and I'm very active in social media. By now, I think the majority of you know how to reach me. I hope you all enjoyed it. Have a wonderful, as we begin to wrap up 2023 in the coming 30 or so days. Richard, thanks for being a great guest. I look forward to next time. Thank you, everyone.